Disclaimer.
AG here, and I have spent enough years watching markets to know that when paper prices drop $14 while physical premiums jump 40%, somebody's lying. The math doesn't math, as they say, and today we're going to figure out who's holding the bag. Spoiler alert, it might be anyone who thinks the price on their screen represents what they'll actually pay for real metal. Picture this scenario. You check your investment account on a Tuesday morning and see silver futures trading at $72 an ounce on the COMEX exchange in New York. Not bad, you think? But then something catches your attention. In Shanghai, physical silver bars are changing hands at $80 an ounce. Same metal, same day, $8 difference. That's not a pricing discrepancy. That's a system breaking in real time. What if I told you that over the course of just 4 trading days in late December, the vaults beneath the Chicago Mercantile Exchange hemorrhaged 47.6 million ounces of registered silver inventory? That's 60% of the actual metal backing the paper contracts that institutions and traders use every single day. To put that in perspective, imagine your bank branch watching 60% of its cash reserves walk out the door in less than a week. The CME's response tells you everything you need to know about how serious this situation has become. They raised margin requirements to $25,000 per contract, essentially making it prohibitively expensive for smaller traders to participate because they needed to prevent a total market collapse. Here's what should grab our attention right now. We're watching 2 completely different silver markets operate simultaneously, and most people don't even realize it. There's the paper market where futures contracts trade on screens, billions of dollars flowing through electronic systems, prices moving based on leverage and speculation. Then there's the physical market where actual metal changes hands, real bars moving through vaults and across borders, supply and demand playing out in the most fundamental way possible. These 2 markets are supposed to track each other, maintain equilibrium through arbitrage and delivery mechanisms. But something unprecedented is happening. They're diverging. According to CME Group data from late December, the registered silver inventory, that's the metal actually available for delivery against futures contracts, dropped to levels that haven't been seen since the exchange implemented emergency protocols. The institution that oversees the largest paper-silver market in the Western Hemisphere was forced to implement crisis measures typically reserved for systemic failures. Think about what that means. The marketplace, where our pension funds, our investment portfolios, our retirement accounts gain silver exposure, just signaled that the physical metal backing those paper promises is evaporating faster than the system can handle. Shanghai tells a different story, one that reveals the true value of physical metal when paper claims can't be satisfied with actual delivery. The premium that physical buyers are paying over futures prices isn't small. It's not a 2 or 3% gap that traders might explain away with storage costs or transportation fees. We're looking at an $8 premium on a $72 base price. That's an 11% disconnect, and it's widening. The Shanghai Gold Exchange, which handles the world's largest physical precious metals trading volume, is showing us what happens when buyers demand real metal instead of paper contracts. They pay whatever it takes to secure actual ounces. But here's where this situation moves from interesting market dynamics to something that could directly impact your financial future. There's a policy deadline coming in February of this year that could fundamentally reshape how Americans access precious metals through tax-advantaged retirement accounts. Our country holds roughly $9 trillion in 401k accounts right now. $9 trillion. Most of that money is locked into traditional investments, stocks and bonds and mutual funds, with very limited exposure to physical assets like precious metals. What happens if even a small percentage of that capital gains the ability to flow into physical silver? We're not talking about paper ETFs or mining stocks. We're talking about actual metal allocation within retirement accounts. The math gets uncomfortable quickly. If just 1% of our collective 401k assets sought direct silver exposure, that's $90 billion trying to enter a physical market that's already showing severe supply constraints. Current global annual silver production stands at approximately 26,000 metric tons according to the Silver Institute. At today's prices, that entire year's worth of mining output represents maybe $24 billion in value. Now imagine 4 times that amount trying to buy into the same supply. You don't need a PhD in economics to see the problem. Now let me put this in terms that connect to your daily financial reality. Remember when the pandemic created shortages of certain products, when you couldn't find specific items on store shelves even though the price tag said they should be there? This is similar, except instead of paper towels or computer chips, we're talking about a monetary metal that serves as both an industrial commodity and a store of value. And instead of temporary supply chain disruptions, we're looking at structural deficits that can't be fixed quickly because new silver mines take 8 to 12 years to develop and bring online. The Federal Reserve's own data shows that American households hold unprecedented levels of paper wealth relative to hard assets. Our stock market valuations reach levels that historically precede major corrections. Our bond markets face interest rate dynamics that haven't existed in 4 decades. Our real estate markets in many regions have priced out entire generations of potential buyers. So what happens when people start questioning whether the paper promises they hold, whether that's futures contracts or ETF shares or even the dollar bills in their wallet, will maintain their purchasing power? China seems to have asked that question already. And their answer came on January 1st of this year when they implemented export restrictions that fundamentally altered global silver supply chains. But we'll dive deeper into that strategic move and what it means for American access to physical metal in just a moment. For now, understand this. The country that controls 60 to 70% of global refined silver supply just played a card that Western markets weren't prepared for. The backwardation in silver futures, that's the technical term for when spot prices trade higher than future delivery prices, tells us something crucial about market psychology right now. Normally, futures prices should be higher than spot because you're paying for future delivery, compensating for storage and financing costs over time. When that relationship inverts, when traders are willing to pay more for immediate delivery than for metal months down the road, it signals one thing. People don't trust that future delivery will actually happen at prices anywhere near today's levels. Think about your own investment portfolio for a moment. How much of it represents actual ownership of physical assets versus claims on future performance or promises of delivery? Your stocks are ownership stakes in companies, sure, but the value depends on those companies continuing to operate and generate profits. Your bonds are promises that governments or corporations will pay you back with interest. Your cash is a claim on the Federal Reserve's ability to maintain the dollar's purchasing power. What do you actually own that can't be printed, promised away, or digitally created in unlimited quantities? The registered vault inventory at COMEX, which stood at just 128 million ounces as of the latest reports, represents the lowest level since February of last year. That might sound like a lot of silver until you realize it's down 70% from where it stood in 2020. 7 years ago, those same vaults held over 400 million ounces of registered inventory. The metal has been steadily draining, moving from paper market vaults into physical market hands, from west to east, from institutional storage to private ownership. This isn't a sudden crisis. It's the culmination of a trend that's been building for years, finally reaching a breaking point. According to the World Silver Survey, industrial demand for silver has been climbing steadily as new technologies require the metal's unique properties. Solar panels need silver for conductivity. Electric vehicles use significantly more silver than traditional cars. The artificial intelligence boom that's transforming our economy requires massive data centers, and those facilities need silver in their infrastructure and cooling systems. These aren't speculative demands. These are corporations buying physical metal for actual production, taking supply out of available markets permanently. Have you noticed how certain narratives about inflation and currency stability have shifted over the past few years? We went from inflation is transitory to inflation is persistent to inflation is moderating in the span of less than 3 years. Each narrative adjustment came after the previous story failed to match reality. The silver market is showing us a similar pattern of narrative versus reality disconnect. Official prices on futures exchanges say one thing. Physical premiums in actual delivery markets say something completely different. Which story should you believe? The one printed on a screen, or the one revealed by what people actually pay when they need real metal in their hands? The institutions managing our pension funds and endowments operate with fiduciary responsibility to maximize returns while managing risk. When those institutions start demanding physical delivery of commodities instead of rolling paper contracts forward, it's not speculation, it's risk management. They're looking at the same data you have access to, the vault depletion numbers, the supply deficit projections, the east-west price divergence, and they're making decisions to protect the capital entrusted to them. The difference is they can move hundreds of millions of dollars with a single allocation decision. You're competing with that capital for access to the same limited physical supply. The February policy deadline isn't some abstract regulatory change. It represents a potential inflection point where the game changes for everyday Americans trying to protect their retirement savings. If the ability to hold physical precious metals within tax-advantaged accounts becomes more accessible, it democratizes access to hard assets in a way that hasn't existed before. That sounds positive, and in many ways it is. But here's the tension. Democratizing access when supply is already constrained doesn't create more metal. It just creates more competition for what's available. The early movers, the people who understand what's happening before the policy takes full effect, position themselves ahead of the rush. Everyone else pays the premium that comes with delayed awareness. So we're standing at a moment where the paper market that sets prices is showing severe stress, where the physical market that delivers metal is commanding significant premiums. Where institutional vaults are draining at historic rates, where policy changes could unleash unprecedented demand, and where the world's dominant supplier just implemented export controls. Each of these factors alone would be significant. Together, they're creating a situation that hasn't existed in modern precious metals markets. The question isn't whether something has to give. The question is what breaks first and who's prepared when it does. Let's talk about what happened on January 1st, while most of us were recovering from New Year's celebrations. China's Ministry of Commerce implemented export restrictions that fundamentally restructured global silver supply chains, and the move was so calculated that it caught Western markets completely off guard. They reduced the number of approved silver exporters from hundreds of companies down to just 44 carefully selected firms. One stroke of regulatory policy, and a country that controls 60 to 70% of the world's refined silver supply just centralized export authority into the hands of entities that answer directly to Beijing. This wasn't a trade war move or a retaliatory tariff. According to official Chinese government statements, this was strategic resource management. When a country positions a critical industrial metal the same way they position rare earth elements or semiconductor manufacturing capacity, they're thinking about leverage that lasts decades. The timing matters too, because these restrictions went into effect just as Western inventories hit multi-year lows, and industrial demand reached levels that can't be met through alternatives. Here's where the industrial demand story connects directly to the technology infrastructure our entire economy depends on. The artificial intelligence boom everyone's talking about requires massive data centers being built across our country to power machine learning and cloud computing. These facilities consume silver at rates that make traditional industrial uses look modest. Each hyperscale data center requires tons of silver in its electrical infrastructure, cooling systems, backup power configuration, and network connectivity hardware. We're not talking about ounces. We're talking about tons going into permanent installations that won't return to the market for decades. The solar energy sector tells a similar story. According to the Silver Institute, photovoltaic solar panel manufacturing now consumes roughly 100 million ounces of silver annually, and that number is growing as countries accelerate renewable energy buildouts. Each solar panel needs silver paste for its electrical contacts because nothing else provides the same combination of conductivity and efficiency at viable cost. Scientists have tried substituting copper and aluminum. The performance losses make those alternatives non-viable for utility-scale deployments. Electric vehicles add another layer, with each EV using 25 to 50 grams compared to 15 to 28 grams in traditional cars. The International Energy Agency projects 17 million EV sales globally this year, translating to hundreds of metric tons of demand from just this sector. But here's what should really concern anyone holding paper silver investments. The COMEX registered inventory, the metal actually available for delivery against futures contracts, currently sits at 128 million ounces. That's down 70% since 2020. The fact that this number keeps dropping while industrial demand keeps growing tells you everything about the direction of physical flows. According to Bank for International Settlements data, the paper-to-physical ratio in silver trading reached 356 to 1. For every actual ounce of physical silver in the backing system, there are 356 ounces of paper claims circulating through futures contracts, options, and ETFs. Think about this in terms you deal with every day. Imagine your bank operates with a 356 to 1 ratio of deposit claims to actual cash in the vault. Everything works fine, as long as only a tiny percentage of depositors want their cash at any given time. But what happens if just 1% of depositors decide they want physical currency instead of digital promises? The bank fails. It's simple arithmetic that doesn't work when the assumptions break down. The backwardation in silver futures confirms that sophisticated traders are pricing in delivery concerns. When spot silver trades at a premium to futures contracts months out, the market is telling you that immediate possession is worth more than a promise of future delivery. Traders are essentially paying extra to have metal now, rather than accept delivery promises for later. That's not speculation. That's fear that future delivery might not happen at anywhere near current prices. China's strategic move reveals how major powers think about resource security in an increasingly unstable global environment. The 44 firms authorized for silver exports aren't random companies. According to trade analysts tracking Chinese commodity policy, these are entities with close ties to state planning objectives that can be directed to prioritize domestic supply or favor specific trading partners aligned with Chinese interests. Western buyers who previously sourced silver from hundreds of Chinese refiners now have to go through approved channels that answer to Beijing's industrial policy objectives. Our own country's domestic silver production amounts to roughly 1,000 metric tons annually, according to USGS data. That's less than 4% of global supply. We import the vast majority of silver needed for our industrial consumption and technology infrastructure. When the dominant supplier restricts exports and regional premiums start diverging by double-digit percentages, our supply security becomes questionable. The industrial consumption numbers tell a story of permanent supply removal. When silver goes into a solar panel installed on a rooftop, it's gone from the supply pool for 25 to 30 years. When it goes into an EV battery system or data center infrastructure, it's locked into functional use for a decade or more. The Silver Institute estimates that recycling provides only 15 to 20% of annual supply, a number that has not grown much despite higher prices because the applications using silver are increasingly difficult and costly to recycle. According to CPM Group's research, accessible silver inventories in major trading centers represent only 30 to 45 days of global industrial consumption at current rates. That's a supply chain operating with minimal cushion for disruption. Compare that to oil markets, where strategic reserves provide months of buffer. Silver operates in a perpetual state of tightness that gets worse every time industrial demand increases. New silver mining projects face timelines that make rapid supply response impossible. From discovery through permitting, financing, construction, and ramp up to full production, we're looking at 8 to 12 years in most jurisdictions. The projects that would bring meaningful new supply online in the late 2020s need to be starting development right now. And the current project pipeline does not show enough capacity to offset declining grades at existing mines, plus growing industrial demand. The January numbers from COMEX vault reports show metal continuing to flow out of registered status faster than new metal flows in. This isn't a one-month anomaly. This is a trend that's been consistent for quarters. Registered inventory declining while owners keep silver in exchange vaults for storage security, but don't want it available for delivery against futures contracts. They're positioning for a scenario where having physical metal matters more than lending it to the paper trading system. When we look at the evidence, the proof isn't hidden in conspiracy theories. It's right there in official exchange reports, government trade data, and market price divergence anyone can observe. China reduced approved exporters to 44 firms while controlling 60 to 70% of refined supply. Industrial demand from AI, solar, and EVs continues growing with no viable substitutes. COMEX inventories dropped 70% from 2020 levels. Backwardation proves immediate delivery commands premium pricing. Paper to physical ratios reached 356 to 1. Each piece of evidence confirms the same conclusion. The paper market, its ability to deliver physical metal at stated prices, is deteriorating, and institutions that understand this are positioning accordingly. Now, let's do some math that Wall Street would rather you didn't think about too carefully. We established that accessible silver inventories in major trading centers represent 30 to 45 days of current industrial consumption. Not investment demand, not speculative buying, just the baseline industrial consumption from solar panels, electric vehicles, AI data centers, and existing technology manufacturing. 30 to 45 days of supply buffer against disruption. Meanwhile, new mining projects need 8 to 12 years from discovery to full production. Do you see the problem forming here? We have a window of weeks to handle supply shocks, but we need a decade to create new supply responses. Think about what happens in that gap. A solar manufacturer in Germany needs silver paste for its production line next month. An EV battery plant in South Korea has contracts to fulfill this quarter. A semiconductor fabrication facility in Arizona can't shut down for weeks, waiting for materials without costing billions in lost production. These aren't flexible demands that can be postponed or substituted. These are supply chain requirements with hard deadlines and severe financial consequences for failure to deliver. When the physical market tightens, industrial buyers don't politely wait their turn. They pay whatever premium is necessary to secure supply because the cost of production shut down vastly exceeds the cost of expensive metal. Bank of America. His commodities research team published a target of $65 per ounce as their average price expectation for silver in 2026. That report came out when silver was trading in the mid-50s. We've already blown through that target, and we're not even through the first quarter of the year. When major financial institutions set price targets, they're basing those projections on supply-demand models, economic growth assumptions, and historical price relationships. The fact that reality is running ahead of those models this early tells you that the variables change faster than the analysts expected. Either demand came in stronger, or supply came in weaker, or both. Either way, the market is repricing the scarcity faster than institutional forecasts predicted. UBS took an interesting approach in their precious metals outlook by focusing on gold's potential move to $5,400 per ounce. Why does that matter for silver? Because historically, silver tracks gold's major moves with amplified volatility. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has averaged around 60 to 70 over the past decade. Right now, that ratio sits in the mid-70s. If gold reaches UBS's $5,400 target, and the ratio compresses back toward historical averages, you're looking at silver prices that make today's $74 look like a consolidation base, not a top. When monetary metals move together in response to currency concerns or inflation dynamics, silver typically delivers bigger percentage gains than gold, because of its smaller market size and dual role as both monetary and industrial metal. Here's where the timeline gets specific, the stakes get real. January 27th marks the shareholder vote on the Coeur mining merger, a transaction that will determine control of America's largest domestic silver producer at precisely the moment when domestic supply security matters most. Coeur Mining operates the Rochester mine in Nevada, the Palmarejo mine in Mexico, and has development projects that represent significant portions of North American silver production capacity. When a foreign company or investment group gains control of strategic resource producers during a supply crisis, it raises questions about whether production will prioritize domestic industrial needs or get directed toward whoever pays the highest premium globally. This isn't speculation about future possibilities. This is a shareholder vote happening this month that will shape American access to domestically produced silver for years to come. According to World Bank commodity price data and analysis from major mining consultancies, the current silver price environment has created unusual dynamics in producer behavior. Typically, when commodity prices rise, producers accelerate production and bring forward future supply to capitalize on high prices. But silver miners are showing restraint, limiting production increases, despite prices that would normally justify expansion. Why? Because the mining executives, looking at the same supply-demand data everyone else sees, understand that scarcity is going to get worse, not better. Selling forward at $70 or $80 per ounce looks less attractive when you think prices might be substantially higher in 12 or 24 months and your reserves are finite. This producer restraint, combined with the 8 to 12-year timeline for new projects, guarantees that supply won't respond quickly even if prices double from here. Let's talk about what happens if the system actually breaks, because this is the scenario that keeps risk managers awake at night. A force majeure event on COMEX, where the exchange declares it cannot deliver physical metal to a contract holder who demands it, would trigger immediate and severe consequences across global precious metals markets. The term force majeure sounds technical and legal, but it means the exchange is saying, we don't have the metal to fulfill our obligations, and we're invoking emergency provisions to settle in cash instead. For the entity that demanded delivery, probably a major industrial buyer or a sovereign wealth fund, that cash settlement is useless if they needed actual metal for production or strategic reserves. They'll take their cash settlement and immediately try to buy physical metal elsewhere, driving premiums even higher in already tight physical markets. But the real contagion happens in confidence, not just in that single transaction. If COMEX, the dominant price-setting exchange for Western silver markets, admits it cannot deliver metal at stated prices, every other paper silver holder starts questioning whether their positions can be converted to physical if needed. Exchange-traded funds holding hundreds of millions of ounces in various vault structures would face redemption requests from investors who suddenly don't trust that the metal is really there or really accessible. Futures traders who routinely roll contracts forward would start demanding delivery instead, testing the system's actual physical backing. Banks and institutions using silver derivatives for hedging or speculation would scramble to unwind positions before counterparty risk becomes acute. The entire architecture of paper silver trading depends on confidence that physical delivery is available for the small percentage of contracts that request it. Once that confidence breaks, the system doesn't gradually decline. It fails rapidly. History gives us precedents for what happens when derivatives markets lose connection to physical reality. The London Metal Exchange nickel crisis in March 2022 showed how quickly orderly trading collapses when physical supply can't meet paper obligations. The LME suspended nickel trading, canceled billions of dollars in executed trades, and changed margin requirements retroactively to prevent member defaults. That was for industrial nickel, not a monetary metal with thousands of years of history as a store of value. Imagine similar chaos in silver markets, except with the added dimension of investors viewing it as a currency alternative and governments holding strategic positions. The repricing wouldn't be a 20 or 30% correction. It would be a fundamental reassessment of what paper promises are worth when physical metal isn't actually available. Current pricing already reflects early-stage awareness of these risks. That $8 premium in Shanghai over COMEX futures we discussed at the beginning, that's Asian buyers saying they don't trust Western paper prices to remain stable or relevant when they actually need to take delivery. The backwardation in futures curves is traders saying they value immediate possession over promises of future delivery. The drain of registered COMEX inventory is metal owners saying they want their silver in secure storage, but not tied up in a delivery system that might face force majeure. These are rational responses to visible risks, not panic or conspiracy thinking. Smart money is repositioning ahead of potential system stress, which is exactly what you'd expect if the endgame scenarios we're discussing have meaningful probability. Your personal financial situation probably includes exposure to these dynamics, whether you realize it or not. If you own mining stocks, their valuations depend on assumptions about future silver prices and their ability to sell production. If you hold broad market index funds, they contain companies heavily dependent on silver supply for manufacturing, from electronics firms to solar companies to EV makers. If your retirement account includes commodities exposure through ETFs, you are holding paper claims that might not convert to physical metal at stated prices if stress events occur. Even if you own no direct silver investments, your purchasing power and asset values exist within a monetary system where precious metals serve as alternative stores of value during currency instability. When silver reprices dramatically, it sends signals about broader confidence in fiat currency systems and government debt sustainability. The February policy deadline for expanded precious metals access within retirement accounts adds another accelerant to markets already running tight on physical supply. Remember how we started this conversation? Paper prices dropping $14, while physical premiums surged 40%, creating a situation where the numbers don't math and somebody's clearly holding the bag. Now you understand who's holding that bag. It's anyone who thinks the price on their screen represents what they'll actually pay when they try to convert paper positions into physical metal. It's institutions that assumed leverage and fractional backing would continue working because it's worked for decades. It's industrial buyers who planned supply chains around stable availability at predictable premiums. It's investors who did not understand the difference between owning a futures contract and owning actual metal in a vault with their name on it. The calculation is straightforward when you strip away the complexity. Industrial demand is structural and growing. Mining supply responds slowly and requires years of development. Strategic suppliers are restricting exports and centralizing control. Financial markets operate with paper-to-physical ratios that mathematically cannot survive significant delivery demand. Accessible inventories measure in weeks of supply, while new production measures in years of development. Price premiums are diverging between paper and physical markets. Institutional money is starting to position for supply constraints, while retail investors mostly remain unaware. These aren't predictions about what might happen someday. These are observable facts about what's happening right now, creating pressure that builds until something gives. The question isn't whether silver reprices. The question is whether you understand the timeline and position accordingly before the pressure release becomes obvious to everyone. When COMEX registered inventory drops another 20 or 30% and the exchange raises margins again, that's not the time to start paying attention. When another major industrial buyer publicly announces supply constraints affecting production, that's not the moment to reassess your exposure. When Shanghai premiums widen to $15 or $20 above COMEX futures, that's not when you want to be competing with institutional buyers for physical metal. The information is available now. The evidence is clear now. The calculations show the trajectory now. What you do with that awareness is your decision. But the clock is running on the gap between paper prices and physical reality, and mathematics doesn't care whether you're prepared when the system finds its limits. If you made it this far, you're already ahead of 99% of investors who still think the price on their screen tells the whole story. Hit that subscribe button so we can keep tracking this situation together, because when paper promises meet physical limits, the people with information move first. AG out.